Good evening and welcome to today's market analysis. Let's start with a snapshot of the key numbers we are tracking tonight. The 10-year U.S. Treasury yield is sitting at 4.32%. The U.S. dollar index DXY is trading around 98.63. Safe haven demand is clearly on the rise as spot gold climbed to $4,715.20 an ounce, continuing its strong run. On the energy front, WTI crude oil is at $95.42 a barrel, but Brent crude saw a significant sell-off yesterday, dropping nearly 6%. Bitcoin is hovering around $78,321, while the VIX volatility index is at 18.96, indicating that market nerves remain fairly frayed. Our core assessment for today is that markets are experiencing a clear divergence. Capital is rotating out of cyclical risk assets like crude oil and industrial stocks and flowing into traditional safe havens such as gold and U.S. Treasuries. What is driving this conclusion? Let us look at the data. U.S. durable goods orders for March came in at negative 2.1% month-over-month. That number was far worse than what economists had expected. It suggests that the momentum in the U.S. economy may be slowing down. At the same time, Brent crude oil plunged nearly 6% in a single session yesterday. That is a powerful vote of no confidence in future demand. These two data points create a logical. Meanwhile, gold prices are rising and bond yields are falling. All of this confirms that risk aversion is now the dominant theme in the market. When we trace the global capital flow path, we can see this divergence already playing out in Asian markets today. The Shanghai 50 index held up relatively well, rising 0.58%, supported by domestic institutional buying. But the Chi-Next index, which tracks smaller growth companies, slumped 1.41%. This shows that existing funds are selling growth stocks and rotating into low-valuation blue chips for safety. The European Central Bank released some dovish signals, but the market is completely focused on the weak U.S. economic data. We believe the risk-off sentiment we saw in Asia is now being transmitted to European and U.S. markets. Let us break down the major asset classes. For U.S. stocks, we see a weak and choppy session ahead. Deteriorating economic expectations will directly hit corporate earnings forecasts. Both technology stocks and cyclical stocks are under pressure. Gold, on the other hand, has clear upside potential in an environment of recession fears and falling interest rates. For crude oil, the risk of demand destruction is rising. Any short-term bounce is likely to be met with selling pressure. Bitcoin saw a slight price increase today, but its spot ETF has now recorded net outflows for 3 consecutive days. Institutional money is pulling back. In the current macro environment, Bitcoin is more likely to follow risk assets lower rather than act as a digital gold safe haven. Now for our trading strategy for today. Our overall inclination is toward hedging. On the long side, we want to hold gold. On the short side, we want to hold crude oil or growth stock index shorts. The specific execution plan is as follows. First, wait for the U.S. stock market open to confirm the direction. If the S&P 500 index breaks below its key short-term moving average at the open, we can execute the short leg of the trade. For gold longs, we can look for entry opportunities above $4,700. If WTI crude oil closes below $95, we can consider adding to our short positions in cyclical assets. But we must also manage risk. If the VIX index spikes above 22, it would signal a surge in panic. In that case, we should reduce overall risk exposure and lock in some profits. For stop losses, if gold closes below $4,650, our safe haven trade thesis would be invalidated and we should exit the long position. If crude oil climbs back above $100, concerns about demand destruction would ease and we should cover our shorts. Let me wrap up with a clear directional conclusion. The main theme of today is risk aversion. We assign only a 15% probability to an up day, a 40% probability to a sideways day, and a 45% probability to a down day. Investors should stay cautious and manage their risk carefully.